Hi, let's cover my Elliott Wave analysis on Bitcoin, and in this video I will specifically focus on this structure. Now, in the previous update, when price was ranging over here, the probabilities were higher to look for a move towards the upside, and we got a solid move towards the upside, after which price started ranging. Now, this range here consists of a lot of little three-wave corrective structures, making things quite complex. But if we stick around on the 1 hour time frame, we can make sense of what is happening here. And at the end of the video, I will simplify everything, and I will also talk about where the opportunities are from an Elliott Wave point of view without being involved in this range, because CBA, the complexity here on the lower time frame. So first of all, we have this scenario on the chart, a WXY, so a three-wave structure to the downside, wave W, followed by a three-wave move to the upside, wave X, and then a triangle in a wave Y. A, B, C, look for D, look for E, and then a move towards the upside. The move towards the upside here should then be a five-wave structure, preferably an impulse, 1, 2, 3, 4, 5. This also means that we can keep an eye on the trend and turn methodology. Looking for a couple of 1-2s overlap in the beginning, price then moves up and accelerates on increasing volume, that's your sharp move, and then price starts curving again, going from vertical to more sideways price action as price overlaps once more, preferably on decreasing volume into an area of resistance. That is where the opportunity lies, and then look for a move towards the downside. Now, the invalidation for this scenario is price moving to the upside here, taking out the high of B at 92.3K, or move down over here and move below the low of wave A at 88.9K. You need to finish a wave D and a wave E before price is allowed to move towards the upside and move beyond wave B. Now, the bearish scenario is a finished structure to the upside, ABC, done, and you're looking for continuation to the downside. In this particular scenario, this move down is counted as an impulse. So wave 1, 2, 3, 4, 5 wave structure in a wave 1, which means that inside wave 2, we need to look for a 3-wave corrective structure. In that case, we then have a wave A towards the upside, an impulse, followed by a triangle in wave B, and we're still looking for another leg up in a wave C. A, B, C, D, E, move up, move down, then move up, finish wave C, then go down. Wave C internally should also be an impulse to the upside with a bunch of 1-2s, get your 3, bunch of 4-5s, decreasing volume into resistance, opportunity, look for price to move down. Now, preferably, wave 2 does not touch the 886 Fibonacci at 93.4K. If price moves up and touches the 886, probabilities decrease that this move down is a wave 1 and this move up is a wave 2. The invalidation for this bearish scenario is price moving to the upside and taking out this high at 94.1K. And also in this scenario, you preferably continue this range for a little bit longer between the boundary of the wave B here at like 94.4K and the low of your A here at like 89K. Now, the invalidation of this triangle is exactly the same. D is not allowed to move beyond B. E is not allowed to move beyond C over here. So here I put wave C at this particular low. Now then we have another option, because the other two scenarios actually have the same directional bias. In both of these cases, you're looking for price to move towards the upside. So here, this is your more bullish case. You look for a bigger move towards the upside. But here, you're also still looking for a break of this triangle to the upside. And then depending on the structure to the upside, you'll know if you're going to end here and then go down, or if we continue towards the upside. But the direction is the same. So in a matter of fact, if we analyze this range separately, both of those scenarios lead to upside, are short-term bullish, which means we always need to consider a scenario where you move to the downside and you don't take out that high. And that is what I got for you here, right? An Elliott Wave analyst always needs a bullish and a bearish scenario. And in the other two scenarios, price would move up. In this scenario, you don't. So here, the move towards the downside is labeled as a wave A. The triangle is wave B, and then you look for a wave C to the downside. Now, in this particular case, this wave A has to be a 5, 3, and this then also has to be counted as a 5. Now, especially the end of this structure here is very, very messy and overlappy, so I don't really like to go into the very low time frames, but basically this needs to be a three-wave structure in an A, three-wave structure in a B, and you look for a C, D, E, and then price moves down. Now, short term, very short term, the movement is the same. You look for a move up, you look for a move down. And then in the other two scenarios I've showed earlier, you continue to the upside here. And then either you go down for the bears or continue up for the bulls. But here, you do not take out the high of your C. So you don't continue to the upside. Instead, you create a lower high, that's E, and then price moves down. Now, as price then moves down, we want it to move down, preferably as an impulse. That is most common. So you then get a couple 1-2s, 3, couple 4-5s, and then guess what? Trend and turn methodology, which by the way is part of Kuhn's theory to simplify reading the chart like a book. You have the overlap here, sharp move down, increasing volume, price starts curving again from vertical to horizontal, overlap comes back, decreasing volume into an area of support, opportunity, look for price to move up. That's where the opportunity lies. So now based on these three scenarios that I've shown, you can see that the opportunities that I keep an eye on are actually not part of this range at the moment, because this is just sideways mess. I'm not really interested in it. I would preferably wait for a bit of a breakout or clarity, and then as the move ends, that is then where the opportunity lies. Now we have one more scenario that I have on my chart, which is this one here, which is a WXY, so zigzag W, flat in X, and then a flat in a wave Y. However, not the greatest probabilities because of your wave C. So your wave Y is a flat A, B, C. Wave C in this case is an ending diagonal, 1, 2, 3, 4, 5, which is a valid structure for a wave C. The problem is time. So this vertical line on my chart is a fib time taken from the start of A to the end of B. And you're comparing A plus B against C. Now, preferably wave C ends, and by far most commonly, ends before the 2 fib time sitting on the 9th of December, which is today, 4 p.m. Central European time. Before you touch this line, you preferably finish a 4 and get a 5 down and finish 5, which is very unlikely to happen. So that decreases the probabilities for this scenario. Now the hard invalidation, as time is never a hard invalidation, but it's definitely significant, the 2 here on the chart. But a hard invalidation is price moving to the upside to 91.3, touching this line, which by the way is a line which comes from a channel. So in a contracting diagonal, you can take a channel from the end of 1, end of 3, end of 2, and then the invalidation is the other side here, this one, this trend line of the channel, because a contracting diagonal needs contracting trend lines. And then you have this level here, which is the 1-to-1 trend-based fib taken from the start of wave 3 to the end of wave 3 to then wherever the high of 4 is going to be. Currently that's here. If price moves up, it's going to be there, which means this level moves up a little bit. Okay. Now then we get to the levels, right? My conclusion will follow to make things very, very simple. So let's focus on the levels first, shortly showing you my SR levels here. These are the volume levels, which are my favorite levels. To the upside here, we have some interesting resistance. 95, 96 is still not touched locally. You can see a bit of support, bit of resistance, right? There's a couple of things going on, which is nice because those are going to be areas of interest, which I'll show in a second. Here you have time frame horizontals. Then here is the order blocks. So we have an order block to the downside here around 86, 87K. And then to the upside, the next one is 101 to 103. And then finally, have a look at CVD. So this is the 4-hour time frame CVD chart. And by the way, CVD, it's for free. If you go to Discord, to the Good to Know channel, you can download a CVD for free, which also includes lines, and there is also another version of CVD. You'll read it in the group. So this is the CVD chart. You can see that this bullish CVD here already played out because price moved up. But on the 4-hour time frame, we can see that price creates higher lows, and here we have another bullish CVD with this pivot. Higher low in price, lower low in the CVD. And that's interesting because the target for this bullish CVD is taking out the high at 94.1K. If we go to the 30-minute time frame, because CVD is generally best used on lower time frames, but even if we go to a lower time frame like a 30-minute time frame here, you can see that we do have bullish CVDs, but we don't have active open bearish CVDs. This bearish CVD here already played out. Right? Can go to a 15-minute time frame. You still have the bullish CVDs. Zoom out a little bit here. Bullish CVD is visible, but there's no bearish active CVDs since the recent high. These are all already played out. And that's something we can keep in mind, which can have a little bit of an impact on the directional bias and the breakout of this range. Now, we also have news. We have news today and we have news tomorrow. Today at 4 p.m., tomorrow at 8 p.m. Central European Time Zone. Tomorrow is FOMC, so it might be more interesting, more volatile, but just make sure that you trade safe around these hours as volatility can kick in. And then we get to the conclusion and the polylines. And the polylines is basically a visual representation of the expected price action per Elliott Wave scenario. And as I write in the text box here, the white boxes on my chart, these three here, is where great opportunities lie. And that has to do with the trend and turn methodology. This move to the upside would be most likely an impulse. Same with the orange line to the upside and the yellow line to the downside, which means that to the upside, for example, with the orange line, we like to see some overlap in the beginning, then a sharp move to the upside on increasing volume, and then price starts to curve from vertical to horizontal, overlap returns, decreasing volume into an area of support or resistance, support for yellow, resistance for orange, as well as for red. And then that is where the opportunity is. Now, this range locally at the moment, not too interesting because of all the three-wave structures. Waiting for a breakout does make sense. And we do have some news coming later today and tomorrow as well, something to keep in mind. If we do keep in mind the CVD divergences that I showed earlier, then the probabilities would be higher to see a movement to the upside and break the range here, taking out the high at 92 and possibly the high at 94.1K. Alternative case would be that if price does move to the downside out of this range, that we create a higher low, maintain the bullish CVD on the 4-hour time frame from this low to the upside. Currently, the CVD is visible over here. If you would make another low, then this would be the new bullish CVD, and then look for a move towards the upside over here. Now, that being said, I hope that this video was helpful or valuable to you. On the left, you can see a video that shows the simplest way to use and trade Elliott Waves without even counting. And on the right is the Elliott Wave educational playlist to help you understand more about Elliott Waves. Thanks for watching and subscribing, and I hope to see you at the next one. Bye bye.